And we also have Dr. Wei Tui with us from the UCL Department of Economics, who has kindly agreed to introduce Mr. Haldane. So without further ado, I will let Dr. Tui introduce Mr. Haldane, and I hope you all enjoy the event.
Thanks, Vandarika. Hello, everyone. My name is Wei Cui. I'm a lecturer at the UCL Economics Department. I specialize in monetary fiscal policy interactions with financial market interactions. It is my great honor to introduce Andrew to the crowd in this special event. Dr. Andrew Haldane is the Chief Economist and the Executive Director of Monetary Analysis and Statistics at the Bank of England. He's a member of the bank's Monetary Policy Committee and the chair of the government's Industrial Strategy Council. He's an honorary professor at the University of Nottingham, a visiting fellow at Nuffield College, Oxford, a fellow of the Academy of Social Sciences, and a governor of the National Institute of Economic and Social Research. In 2014, he was named by the Time magazine as one of the world's 100 most influential people. Andrew holds an MA and an honorary doctorate degree from University of Warwick. He has authored around 200 articles and 4 books. His writings and speeches always look at the most urgent issues faced by the UK economy. His recent speech about the pandemic's effect on the way people work, which I really enjoy reading, pointed out different impacts on productivity, creativity, happiness, and hours of work, together with the implication for the UK economy. Today, Andrew will bring his unique perspective on central bank independence during this difficult time. While some of you attended my lecture last week and obtained basic understanding of central bank independence, I'm sure that Andrew today will broaden greatly our understanding of this topic. After all, he's one of the central bankers in our model. Now, let's welcome Andrew. And let me give the floor to Andrew.
Well, thank you, Dr. Chue, for that very kind introduction. And thank you also to the UCL team for inviting me and for putting together this fantastic program. It's a shame it's on a Saturday, but you know, we're all in this together now. I'm going to try and share my screen with you to take you through a few slides. So just bear with me for one second. So I want to talk a little bit about a subject that's close to my heart, as you'd expect, being a central banker, and that topic is central bank independence, independence in the setting of monetary policies, independence in the setting of financial stability policies. This is my title. My title, like much else what I'll say today, is stolen. It's taken from somewhere else. It's taken from a film none of you probably heard of, produced by people you've also probably never heard of because you're all too young. But the film was called The Life of Brian. The team was called Monty Python. And there's a scene in that film that none of you've seen because you're all too young. And the line is, "What have the Romans ever done for us?" And what follows from that is lots of people volunteer things the Romans have actually done for us, like roads and irrigation systems and sanitization systems and medicine and law and public order, and there was lots of things. Now, central banks are not as useful as Romans. They can't produce any of those things, but there are some good things that central bankers like me can produce, and prominent among those is price stability, low and stable inflation, and financial stability, safe and stable banks. I'm going to talk you through some of the theory and some of the evidence about why central bank independence can help those two things. But, and it's an important but, these are challenging times for the economy and for central bankers. Some of the actions that central banks have taken most recently, most notably their purchases of government securities, so for so-called quantitative easing or QE, has raised questions, has raised challenges about the blurring of the distinction between monetary and fiscal policies, but also some questions about central bank independence. And today I thought I'd try and confront some of those challenges with you head on, and indeed suggest ways in which central banks might seek to rise to those new challenges that they face. For those of you who are interested, there's actually a speech to accompany all this, all written out longhand. So for those of you who are bored already, you can afterwards, if you like, go and read the full text of the speech to get chapter and verse on what is about to follow. So let me start at the beginning. And it's a good news story for central banking, because I think for most of the 20th century, we saw central banks and central banking and independence for their actions on the up, on the rise. You might even say that the 20th century was the age of central banking. At the very beginning of that century, there were only about 18 central banks in the whole world. And almost none of those had well-defined policy responsibilities. Fast forward 100 years, by the end of the 20th century, pretty much every nation state on the planet had a central bank, and a good number of those, the vast majority in fact, had also been granted a degree of policy independence, particularly on the monetary policy side. This slide just looks at the fraction of central banks over the last half century that have independence either over monetary policy, red, or in general in blue. That has been a line that's trended upwards, and currently the lion's share of central banks globally, and therefore the lion's share of countries globally, have granted their central banks a degree of independence, between 80 and 90% of the central banking population. I mentioned the challenges to independence of late. One of the sources of those challenges is just shown here, which looks at the balance sheets of central banks measured relative to GDP over the last 120 years or so. And the key takeaway from this chart is just how high, how large those balance sheets have become over the past 10 or more years as a result of those purchases of government securities I mentioned earlier on, so-called QE. And it's really this, among one or two other things, that have caused central bank independence, indeed central banks themselves, to be challenged. And I want to touch upon some of those challenges towards the end of my talk today. Those challenges were captured, I thought, quite nicely by The Economist magazine. This is the front cover of their magazine just last year. And the clear implication from the picture here is that central banks were at risk, their independence was at risk from interference from governments and from politicians. And the largest single cause of that concern was those large balance sheets and large holdings of government assets that I showed you on the previous slide. So here's a rough plan of what I want to talk about today. I want to talk about the ways in which central banking can help, in particular the ways they can help when it comes to monetary stability, that is low and stable inflation, the ways in which independence can help when it comes to financial stability, that's keeping banks strong and stable. And we'll say some words about how monetary policy and fiscal policy, government policy, interact and interplay, including most recently, and then end with some more forward-looking thoughts on what central banks need to do next to reinforce their independence and to keep on producing those good things of monetary and financial stability. And some time at the end for some questions from all of you, I hope. So let's kick off then and talk a little bit about central bank independence and the first stability leg, that is to say, price stability. Well, context here is important because the context for many central banks becoming independent was the inflationary experience of the 1970s, which was by no means good. Indeed, it was bad by any historical metric. Inflation was high and volatile. There was the so-called great inflation. Nothing much great about it, but great nonetheless, of the 1970s, which begged the obvious question, why had that happened? And what role had monetary policy in generating that great inflation? Well, some of the answers to those questions were provided in a sequence of very elegant theoretical papers. I've mentioned one or two of them here. The essence of which were that this so-called inflation bias could result from governments setting monetary policy in a way that was rather too focused on the short term, perhaps for electoral reasons, and insufficient on the longer term inflationary consequences. In other words, they were setting policy in a way that was time inconsistent. There was a natural temptation, especially pre-election, to try and run the economy hot. That fueled future inflation. And if everyone recognized that in expectation, what you got was this persistent inflation bias, which may have shown up as the great inflation of the 1970s. So the next obvious question, if that is the problem, what available solutions are they? And Ken Rogoff, in the middle of the 1980s, came up with a particularly elegant one, theoretically. This is the notion of a conservative or inflation-averse central banker, one that was at arm's length, independent from government and politics and elections, and who therefore could lean against any tendency to overinflate the economy for short-run gain. And one of the nice things about the Rogoff framework is that what that suggested was that central bank independence was in effect a twin win, by which I mean not only would that squeeze inflation bias out of the system by having central banks behave in a time consistent fashion in their setting of monetary policy, but also, in addition, that still left plenty of room for central banks to help stabilize the broader economy, GDP, jobs, and income. And in that sense, central bank independence, at least according to the theory, was something of a free lunch, something that in general we think doesn't exist. That is to say, it could deliver lower inflation, more stable inflation, without any adverse cost in terms of heightened variability in the real economy, jobs and output. Well, if that was the theory, to what extent was that theory borne out then from the evidence? Let me show you one or two bits of evidence that speak then to these twin hypotheses of what the benefits of central bank independence might be. And that's what these pictures do. They plot a measure of central bank independence running horizontally against a measure of inflation, that's the first panel, inflation variability, that's the middle panel, and output variability, that's the far right panel, over the period from 1970 right up to the end of the 20th century. And the key takeaway here, two key takeaways from this, which is a sort of cross-country scatter plot of correlations with a line of best fit shown for a bunch of countries, is that over this time period, there was indeed a negative and statistically significant relationship between central bank independence on the one hand and inflation and inflation variability on the other, bearing out the first of Rogoff's hypotheses. Other things equal, central bank independence appeared indeed to result in lower and more stable rates of inflation. And the final panel speaks to the second half of the Rogoff hypothesis, which, as best we can tell from this picture, the move to independence also doesn't result in any increase in output variability. The line of best fit here is not significant. Statistically, if anything, the line is downward pointing rather than upward pointing. So on the face of it, this evidence over this roughly 30-year window strongly supported the case for independence. Indeed, was an important catalyst for the drive towards greater amounts of central bank independence in the latter half of the 20th century, and was also bang in line with the theory that Rogoff had laid out. What was true internationally was true here in the UK as well. This plot just looks at, for the UK, over a set of sample periods, a measure of inflation running vertically and output running horizontally, variability. The Bank of England became independent for monetary policy in 1997. In the immediate aftermath of independence, we saw the variability of inflation sharply lower, in line again with Rogoff's theory. Well, if that was the evidence up until the end of the 20th century, what has been the evidence since? Well, that paints a somewhat different picture. This replicates those charts I just showed you, but over the later sample, taking the period now of the 21st century, from 2000 up to 2019, same set of countries, same set of variables. And what you'll notice here is that negative relationship between inflation and the variability of inflation and central bank independence has suddenly disappeared. That correlation looks roughly to be around zero. This chart just looks at a rolling correlation coefficient between independence and inflation. You'll see over the latter part of that sample, in particular during the 21st century, that correlation has been indistinguishable from zero, at least in the statistical sense. Which begs the obvious question, what has happened? What has gone wrong? Why is independence seemingly not working as we have entered the 21st century? Well, some have argued that's because the earlier correlation was in fact something of a mirage in a statistical sense, by which I mean it may not have reflected the effects of good policy management by central banks as a result of their independence, but was instead the result of good fortune, of good luck. In particular, the fact that over that earlier window, over that earlier period, the macroeconomic environment was actually fairly benign, what's sometimes called the period of so-called great moderation. And it was that great moderation, that lucky streak, if you like, economically, that generated that correlation rather than anything special about central bank independence per se. That's one hypothesis. I'm going to argue, maybe you'd expect me to, but I'm going to argue that hypothesis is mistaken. And in fact, central bank independence is still doing as much good in keeping inflation low and stable as it was during the 70s, 80s, and 90s. So why do I say that? Well, two reasons really. One is slightly nerdy, slightly conceptual, and the second one is much more empirical. The conceptual one, and this is an old conceptual point really, is that the sort of reduced form correlations between two variables that I showed you can sometimes be quite misleading when it comes to gauging what true impact policy or a change in policy regime is having. I mean, for example, after all, if a policy is fully effective in stopping bad things happening, such as high levels of inflation, then those high levels of inflation never happen. And any correlation between the policy regime or policy action and the end state variable will effectively disappear. This is what's sometimes known as the unobservability of optimal policy. After the fact, in the reduced form, you wouldn't expect to find much correlation between inflation and independence because most countries have already locked in to a regime of both high independence and low inflation. The second piece of evidence is more empirical, and that comes from looking at behavior of inflation and indeed inflation expectations over the period of not just the Great Moderation, but what happened after the Great Moderation with the dawning of the global financial crisis and indeed the rather rockier macroeconomic landscape of the past few years. So as an example of that, this is a plot of inflation, actual inflation, and inflation expectations, in this case drawn from financial markets in the UK. I've plotted the second because that's actually a good indication of the credibility of a monetary policy regime. And I've divvied up this chart into 3 bits. There's the bit pre-independence on the far left-hand side. And during that episode, you can see from the box in the middle, which provides some summary statistics on inflation and inflation expectations over these 3 windows. Pre-central bank independence at the Bank of England, both inflation and inflation expectations were very volatile, consistent with big shocks and a low degree of credibility in the monetary regime. After independence in 1997, we saw both the variability of inflation and of inflation expectations going down. Now that could be the result of independence, but could equally be the result of shocks to inflation having been rather benign, hence the Great Moderation. So over that middle window, it's hard to distinguish an independence story from a Great Moderation story. However, that isn't true when it comes to the third window, the most recent period since the time of the global financial crisis. Over that period, the macroeconomic environment has been anything but benign. And the variability of inflation has picked up roughly 3-fold over that period, reflecting those larger number of larger shocks, including, of course, most recently, the COVID shock. However, despite that less benign macro environment, it has remained the case that inflation expectations, the credibility of the monetary regime in the UK, has remained rock solid. If anything, the variability of inflation expectations has fallen over that latter period, despite the macro environment being much, much less benign, consistent with independence and the monetary regime having played a much bigger role, enabling us to distinguish good luck from good management. The evidence now is much clearer that good management in the form of independence has played a crucial role in the UK and internationally over the most recent period. Now, before I end definitively on the price stability side, just one more picture, which I'll come back to. And this just looks at inflation and again, inflation expectations, but broken down now by age cohort, the expectations of different groups of individuals, different age ranges. And the top 2 with red circles around are inflation expectations for the youngest age group, your age group, if you like, which is 15 to 24 and 25 to 34. And the key point there is that among those age cohorts, inflation expectations are somewhat lower, and those expectations are also somewhat less stable. there seems to be a bit of a lesser degree of inflation aversion among younger people, perhaps most likely because those younger people have not lived through those great inflation experiences of the 1970s. And that's an important point looking forward if the emerging generational dynamics are towards a less inflation averse population. I'll come back to that in a second. I want to turn now, though, to the financial stability, strong and stable banking sides of the equation. Truth be told, there's far less evidence, whether practical evidence from central banks or research evidence, on what the links are between financial stability and independence. Nonetheless, many of the self-same questions on the monetary policy side still apply. For example, why is it we see over time incidences of financial crises or instabilities being repeated? What is the dynamic behind that? What is causing that, if you like, instability bias alongside the inflation bias we know that comes from monetary policy? Well, some of the most recent theory provides a ready-made answer to that question. In some respects, it echoes and mirrors the theory we used to explain inflation biases, namely that governments have a temptation to act in a time inconsistent fashion, running their financial systems hot during credit booms, and therefore sowing the seeds of future bouts of financial instability. In some ways, they're going to mirror image of the story on the monetary policy side. In fact, this time consistency problem might in principle be even more acute when it comes to financial stability policies than was true of monetary policies. Why do I say that? Well, one reason is because credit booms, financial cycles, tend to be longer lasting than business cycles. And that means it's easier, it's more likely that governments might act in a short-term fashion, mistaking a credit boom for a structural shift in the economy. And the second reason I think the time consistency dilemma is more acute is because the costs of financial crisis are at least as large, if not larger, than the costs of bouts of inflation. And that means it's that much harder at times of financial crisis for governments to step back and not to intervene after the fact in the event of disruption. Both of these points were very well illustrated by the global financial crisis, a very, very long-lived credit boom that caused many people to say, this time is different, this is structural rather than cyclical. But when the boom turned to bust, governments felt duty-bound to step in and support. They behaved in a time inconsistent fashion. Well, if that's the problem, what's the solution? Well, funnily enough, again, mirroring the monetary literature, the solution, the ready-made solution, is pretty similar. The institutional fix to this myopic government financial stability problem is to put in charge of financial stability policies instead a longer-lived, less myopic, independent central bank or regulator. And if you do that, the theory would tell you that once again, you can secure a twin win. That is to say, you can both reduce the probability of future financial instabilities, reduce that instability bias, but without coming at any cost in terms of undermining the efficiency or competitiveness of the banking system. The exact same analogues as on the monetary side, you will note. And the question, of course, this theory begs is what I say true then in the evidence, in the practice, as well as in the theory? Well, this chart just tells us no more than, this just plots the degree of independence among central banks generally, that's orange, and for regulatory and supervisory policies, financial stability policies, that's blue. This just tells us that there has been a renewed wave of independence for those financial stability policies. as a result of the global financial crisis, but nonetheless, that's still lagging independence on the monetary side. What this table does, which is it's taken from a piece of research that we at the bank have done. Some fairly sophisticated econometrics lying behind this. I've simplified it here. And what this chart is looking at is the results of a regression that looks at the extent to which independence of financial stability policies have reduced the incidence of financial instability in the banking system, which in this case is measured by looking at the number of non-performing loans, bad loans if you like, in the banking system. That's the first column here. Or at the degree of volatility or variability in the returns banks earn on their assets. That's the second column here. The key takeaway there, without getting too absorbed by the detail, is that what this regression suggests, similarly to those cross-country correlations I showed you early on, is that independence of central banks in respect of financial stability policies has a statistically significantly negative relationship with future bouts of financial instability, measured here by bad loans or variability in banks' assets. In other words, the theory is indeed borne out by the empirical evidence. If you did some back of the envelope calculations, that would tell you that the move to more independent central banks for financial stability policies over the past, say, 20 years has led to a material reduction in the likelihood of banks running up bad loans, perhaps of several percentage points, which is well worth having from a crisis perspective. What about the second leg? Has this drive towards more independent and perhaps more stringent financial stability policies come at some cost in terms of the efficiency and competitiveness of the banking system? This table speaks to that, and without going through in detail, the bottom line is no. As best we can tell from this econometric evidence, there is no real evidence of the move to independence having caused any adverse side effects in terms of how efficiently, effectively, or competitively the banking system can operate. We have now evidence of not one, but of two twin wins. A twin win for price stability, low inflation at no output cost, and a win for financial stability, reduced future financial instability at no cost in terms of financial efficiency. Now, at that point, it's very tempting to sit back and collect applause from you all at just what a good job central bank and central bankers like me have done. But of course, that would make the talk a bit boring because it would underplay what are a quite important set of challenges that are facing central banks and central bank independence just at the moment. And the most pressing and most important of those challenges relates to the links between monetary policy on the one hand and fiscal or government policies on the other. In particular, going back to where I started, the rising incidence of QE, of government holdings of government assets by central banks, which in some people's minds has blurred the distinction between monetary and fiscal policies, and therefore led to some blurring as well in the true degree of central bank independence. So let me just make one or two quick points, theoretical points backed up by evidence, about those all-important links between fiscal and monetary policies. And the first one is that, at least in theory, it's of course certainly possible that fiscal and monetary policies could trip themselves up. And the reason for that is because both monetary and fiscal policies have impacts on the economy, on activity, and on inflation. So in principle, there are spillovers from one to the other. There are externalities, possibly, from one to the other. A second important bit of theory, though, tells us that provided the monetary and fiscal authorities have well-defined and clear mandates that they can pursue independently, that there's no real problem when it comes to coordinating fiscal and monetary policies, because each side of the equation simply internalizes those spillover effects when setting their own policy stance to meet their own targets. So for the Bank of England, that means we internalize the effects of fiscal policy when we choose the monetary policy necessary to hit our inflation target. In other words, those externalities can be internalized. In fact, if you think about shocks to demand, shocks to activity, the like of which we've of course seen recently, you would fully expect fiscal and monetary policies to be operating in a complementary fashion, both expanding so as to cushion any hit to activity, with both monetary policy expanding through QE and fiscal policy expanding through larger fiscal deficits. Some have drawn a link between the two in saying, is this not an example of monetary financing, of the central bank hoovering up the government debt? But of course, that is a misthink. So what's actually going on here is that both monetary and fiscal policies are responding to a common shock. One isn't following the other, one isn't driving the other. It's that both are being driven by a common shock, namely the shock to activity. Both are acting in a counter-cyclical fashion. Any correlation between them is just the consequence of them both being hit by this common shock. So when people talk about in the media elsewhere monetary financing, that is confusing coincidence with causality. Or put differently, provided the Bank of England, central banks, provided their independence is safeguarded, provided their inflation target is safeguarded, there's no reason to think that their actions will somehow be dominated fiscally by the government. And this isn't a bad description, in fact, of the situation right now, where the economy has faced a big negative shock as a result of the COVID crisis. Both monetary and fiscal policies have expanded. That isn't an example of fiscal driving monetary, of monetary financing or fiscal dominance. It simply reflects the fact that both tools are operating in a complementary and supportive fashion. It's actually rather helpful for us in terms of meeting our inflation target, that fiscal policy is expansionary, that's expanding activity, boosting inflation, and increasing the chances of us getting inflation back to its 2% target. It currently sits somewhere below that 2% target. I'll put differently again, there are indeed externalities between fiscal and monetary policy, but right now, those externalities from a monetary policy perspective, from fiscal policy, are actually rather helpful in causing demand to pick up, inflation to pick up, and therefore helping support monetary policy in getting inflation back to target. Now, a less conservative central banker than me would have ended the presentation there, but I'm not going to, because at the same time as saying all of that, which I believe to be true as a matter of theory and evidence, it is the case that concerns about these things, about monetary financing and independence, are widespread. And it's not difficult to see why those concerns are widespread, given the scale of the government asset holdings that many central banks have right now. Let me just demonstrate that for the UK. This is the Bank of England's balance sheet, pretty much since it started. We were born in 1694, which is slightly before this chart starts. It looks at our holdings of government debt as a fraction of total government debt, that's blue, and of total national income, GDP in the UK, that is red. And I've shown on here the actual picture, those are the thick lines, and then see these dots in the top right-hand corner. That's where we will expect to be when the Bank of England and the MPC, on which I sit, completes the asset purchase program it's currently in the throes of undertaking. And the key takeaway from all this is that this will take the bank's balance sheet into uncharted territory, in fact, deeply uncharted territory, getting close to half of the debt stock of the government and half of national income when it comes to the Bank of England's own balance sheet. And it's pictures like that, I think, that have been the root cause of some of the concerns that have been expressed recently, which include, what is this QE? We don't really understand what's going on and how it differs from fiscal policy. There's a concern that the larger that stock of QE, the harder it will be to get rid of that stock in future. Is there a risk that what are temporary actions to expand the bank's balance sheet could, in the event, turn out to be persistent or permanent expansions of the money stock? There's also some concerns in some quarters, including in my quarter, I'd say, that people are increasingly forming expectations of QE, monetary policy actions, being driven by fiscal concerns, which would be very worrying. Because if your aim, as one of our aims are right now on the MPC, is to keep yields and borrowing costs in the economy very low, and if people's expectations of QE are being driven by fiscal concerns rather than macroeconomic concerns, such as activity and inflation, it's very difficult for you as a central bank to navigate. Because if you don't validate those expectations, it carries some risk of yields rising and borrowing costs rising at a time you don't want that to happen. But of course, if you do validate and follow those expectations, there's a risk that policy is then being driven too much by fiscal concerns and too little to the macro and inflation concerns that are, of course, our core mandate. That then begs the question, what might be done and where does this leave central banks? And this is where I will leave you with some open questions. So the story so far is of central bank independence having been a good thing. The theory suggests that, the evidence suggests that, a twin win for both monetary stability, low inflation at no output variability cost, and financial stability, a reduced incidence of crisis at no cost to the efficiency of intermediation. Nonetheless, if central banks are to rise to these challenges, rise to these concerns, there are several things I think quite important that they do. One of them, very obvious thing, is to make absolutely sure that they have a laser focus on their core mandates of price and financial stability. Understandably, during the course of this year, there's been a focus on the short-term path of activity in the economy. And that's one reason why monetary and financial policies and fiscal policies have expanded very rapidly to stabilize short-term activity. But looking ahead into next year with a vaccine, fantastic news on the horizon, as the economy picks up pace and recovers, super important that central banks absolutely return to their laser focus on inflation, on their core mandate and stabilizing that. Secondly, there's a crucial role for central banks to play in what we sometimes call building a constituency for their policies, for price stability and for financial stability. I showed you earlier on those pictures of inflation expectations among younger people. And perhaps the youngest generation, your generation, are a bit less inflation averse than your parents and grandparents. I think at this time of great uncertainty, where there's sometimes a lack of understanding about what central banks are doing, especially on the QE front, it's important we redouble our efforts to build that constituency with as wide a range of the population as possible. That includes doing things like we now have at the Bank of England over the past few years, these citizens panels, talking to people directly right across the UK. Community forums, speaking to community and faith and charitable groups about the role of the bank and the role of monetary policy. We have a youth forum that does this for younger people. We've simplified our communications, our publications, to make them more accessible to a wider audience. We have an educational program within schools for kids aged 8 to 11 and 11 to 16. And of course, we do stuff like this, which is to give talks in universities and colleges and schools to younger people about what central banking is all about. These things were really important pre-COVID. They are even more important in the light of COVID to build that broad base of understanding, to build that constituency for the objectives of central banks and indeed for the independence of those central banks. My final point before I stop for some questions, because I've banged on for far too long, is about research. There are lots of unanswered questions in the research I have spoken to you about today. And we set out some of those questions just a few weeks ago in the Bank of England research agenda, or agenda for research actually, the so-called BEAR. I'd encourage all of you to go away and read some of the topics research-wise that we are most interested in. And I'd say most important of all, encourage you to pick up the mantle and try and yourselves answer some of those research questions, which are as big and as topical and as important, I think, as at any time in my career. Here's my final slide. You'll be pleased to hear. It's a conclusion without any conclusions, and that's for a reason. You've heard my conclusions. What matters even more right now is for me to hear about your conclusions. It's for you in your research and your study to write the final page of this presentation. What happens next will be determined by you and not by me. You could not hope for a better time to be studying economics. You could not hope for a better time to be studying economic policy. You couldn't hope for a better time to be doing economic policy. But the next chapter of that is one for you to write rather than me. With that, Dr. Chue, I will pass the floor back to you for some questions. Thank you all for listening.
I guess Vandarika will take the lead. But thanks so much for the insightful and encouraging presentation. Really enjoyed it.
Yes, thank you so much, Mr. Haldane, for the brilliant presentation. And I think personally, it was very interesting to learn about, like you said, the twin wins of central independence and their concerns ahead. It was really interesting to learn it from an expert who's in the field, and it's quite different from what we read when we read a macroeconomic textbook. So thank you really for that. And I think I'll first ask if anyone would like to ask their question directly to Mr. Haldane. If so, you can raise your hand. And I think, yes, there are quite a couple of people who would like to. So first of all, Stephen Yu, I will let you unmute yourself and you can ask your question.
Hello, am I audible?
Yes.
We can hear you, Stephen.
Thank you, Mr. Haldane, for this very thought-provoking talk. I'm just wondering, just to go back to the blurred distinction between the fiscal policy and monetary policy you just talked about, I'm wondering in the current situation where conventional monetary policy is losing its potency, how would so like unconventional policy like helicopter money, so like directly supportive of fiscal policy by the central bank, influence the independency of the central bank? Thank you.
Thank you, Stephen. Veronica, do you want to do these one by one, or should we collect 2 or 3 questions and then maybe I'll take them together? Should we do that?
Yes, if that's more convenient for you, we can do it that way.
Just fit a few more in then, that's all. let's do that.
Very well. So would anyone else like to ask their question right away, and then Mr. Haldane can answer for everyone? So I think Americana Chen would like to.
Yeah, can you hear me?
Yes.
You can.
So what do you think about central bank digital currency in terms of central bank independency? Does it give the central bank more power to control and monitor, for example, the transactions and payment cash flows in the economy with more independency from the government, or does it impede their power?
Very good. Thank you. Should we take one more and I'll try to pick those up?
Very well. So I'll now choose the most popular question from the Q&A. So we have Anoop, who is asking, is there a possibility that the headline CPI inflation rate may not always be representative of what the majority of households face? And how would the Bank of England reconcile this issue with its 2% target being based on the headline CPI?
Very good. Let me take those then, Vandarika. They're three excellent questions. And I'll try and be brief so we can fit in at least one more round. So on Stevens, is there sign of monetary policy losing potency, and might helicopter money have a role in restoring some degree of potency? Well, I mean, on the first, I mean, it is the case that interest rates, yields right across the duration spectrum, short-term yields, long-term yields, are currently at very, very low levels in the UK and indeed right around the globe. It's a global phenomenon. In fact, it's been a global phenomenon for at least 50 years, if not for 800 years, that global real rates of interest have been in secular decline. And given that interest rates are one of the key channels through which monetary policy works, therefore, at least in principle, you could argue there's a bit less potency from monetary policy for a given monetary action, given that there's less scope to squeeze interest rates, to squeeze yields now than would have been the case in the past. And there may well be some truth in that. There's a big difference, though, between lower potency and no potency. And we're certainly not in the no potency zone. There's still, I would say, plenty of scope for central banks to do more if they need to, to put a further squeeze on yields and to support the economy if that is needed. I wouldn't encourage people to do that through helicopter money, because for me that definitely would cross the Rubicon into a loss of control and a loss of independence. That implies that it's different people mean different things by helicopter money. Very few of them mean what Milton Friedman talked about when he spoke about helicopter money, which was literally throwing pound notes out of a helicopter. What people more typically think about these days is a permanent expansion in the stock of money. I think we know quite a lot from history about what happens when you do that. It tends to result in rates of inflation that are rather too high. And that's why with our own monetary actions, yes, we've expanded the central bank money supply. We've done it temporarily until such time as inflation is back to its target, at which point we will then contract the central bank money supply. So I wouldn't be a fan of helicopter money, because I think that is a surefire way of central bank independence and central bank's inflation targets being lost, which is the last thing anyone needs right now. Americana's question about digital currencies, again, lots could be said. I shouldn't say too much given the time, but this is a very topical issue for the private sector, for banks, for the fintech sector, and indeed for central banks as well. It's a topic that we at the Bank of England have been thinking and working hard on for many years now. In principle, there are some benefits, whether the digital currency is private or public. There are some benefits in making it cheaper and easier for people to make payments. It's also the case that digital currency might have important implications for monetary stability and financial stability, the two topics of my talk today, which we are now working through very carefully. A digital currency not done well might put at risk financial and monetary stability. A digital currency done well could actually reinforce the potency of monetary policy and increase the degree of financial stability. So it's all to play for. It's a very rich research area, and very much encourage Americana and indeed all of you to do some more work on it. It will be a topic, a key topic for the next several decades, on which we'd hugely welcome research by people such as those on this call. Finally, on Anoop's question, yes, we at the bank and other central banks target a headline rate of consumer prices. We have to, really, because our tools are pretty crude. We can only set one interest rate in the economy to control one end objective, in other words, the headline rate of inflation across the whole economy. So it's an aggregate tool that can only affect aggregate inflation. We, of course, look very closely at all manner of more granular measures of the economy, and indeed more granular measures of inflation. We look at the CPI baskets and CPI inflation rates of different household cohorts to understand how they're being affected by shocks to the economy. That's an important part of understanding the economy. Ultimately, though, with our blunt aggregate tool, we can only influence a blunt aggregate target, and that's headline CPI. Anything else would be distributional, and our box of tricks just aren't well equipped to deal with distributional problems. Let me stop there. And do you want to try and take one more round of questions, Vandarika, or is time up?
We can still have one more question, if that's all right with you. There's still quite a lot of people on the call. So I'll take the one question from the Q&A, which is from Eddie Zhu, who is asking, how can we measure central bank independence, especially in countries where central bankers are appointed by the government?
Yeah, very good question, Eddie. I didn't have time to talk about this in the talk, but it's an interesting methodological question. I mean, independence sounds quite binary, sounds quite absolute, but of course, independence is never binary and is never absolute. There are many different flavors or degrees of dimensions of central bank independence. Actually, in the paper that I mentioned, there's probably now available, or will be at the point I shut up, on the Bank of England's website. I talk about this, the many dimensions of independence, and the way that academics have spent many hours constructing indices of central bank independence, looking at these different dimensions and weighting them together in various ways. So I'd encourage Eddie to go away and maybe read my speech, someone's got to, and look at some of the material in there, including some of the references on what academics have done to construct these indices. Some of them look at the legal status of central banks, including who appoints the governor or who appoints the committee members. Some look, which is, if you might call, sort of de jure, legal independence. Some of them look at de facto independence. In what practical ways do central banks act in independent fashions? Those two things give slightly different answers. As I said, there are many different indices possible, but overall, whichever index you use, you get similar sorts of answers to the ones I showed you today on the links between independence and price stability, and independence and financial stability. So I think that will probably do. I shouldn't trespass into Olivia Blanchard's presentation, Vandarika.
Thank you so much for that, Mr. Haldane. And yes, I think this brings us to the end of the event. So huge thank you from the Economist Society and from the UCL Department of Economics for agreeing to join us today, Mr. Haldane. It's been really a true honor. And thank you also to Dr. Tui for introducing our guest today. And finally, thank you to all of you, who joined today.
Thanks, everyone. Have a nice rest of day.
Thank you, everyone.
Thank you.
Thanks. Thanks, Ms. Haldane. Hope to see you soon in some other occasions.